Good afternoon. Thank you for joining. I'm Jannarone, editor-in-chief of IPO Edge, with a very special guest. Here on IPO Edge, of course, we talk a lot about listed equities, but we have a real estate expert joining us today who you meet momentarily. That is Ferdinand Ruaño, who's the president and CEO of Private Equity Solutions. He's got some pretty controversial views and a very, very interesting investing strategy that we're going to hear about momentarily. Before we bring on the man of the hour, just want to remind everyone to ask questions. If you're watching live, you can submit those via the Zoom portal or send an email to editor@ipo-edge.com. And of course, for those of you, like when I ran into this afternoon, can't watch this live, the replay will be published in about 2 hours after the event. You can also find that on your Bloomberg terminal or on Yahoo Finance. With that, I'm very happy to introduce Ferdinand all the way from Puerto Rico. Ferdinand, thank you for joining us.
Thank you, Alan. My pleasure. Looking forward for this webinar.
Great. Now, Ferdinand, of course, is based in Miami, but he happens to be in Puerto Rico today. Before we get into the nitty gritty here, Ferdinand, I want to ask you a question. As someone whose rent just went up a lot, and I think I speak for a lot of us in saying that, I get this concern that maybe there's a real estate bubble, but you think that's not the case at all. Tell me why. We're not in a bubble.
I think that we're not in a bubble. Perhaps for anyone that wants the essay, we will be more than willing to send it to them. Basically, the reason why we're not in a bubble is because it's an issue of supply and demand. Real estate is a real asset, and real assets are basically dominated by supply, by demand. The reason why it's not a bubble, if we compare 2006 to 2008, it was the opposite. We have more supply than demand, almost 800,000 units in surplus. If you look at the market today, and with the regulations in Dodd-Frank, with the fact that people, they cannot get a mortgage because banks were very tight, very restrictive, and the credits were shattered with the speculation, we created a huge deficit of new homes. I'm talking about single family homes. Most builders, instead of building new homes, they build multi-family housing because they were rentals. So the deficit, if you look at history, construction was around 1.5 to 1.7 million units per year. We dropped to 700,000 units. That deficit compounded between 2008 to 2018. Those 10 years have accumulated deficit of excess demand of 7 million units that haven't been built. The second thing is that you got millennials, which is a generation that is dominating, and now they're becoming parents. They don't have the dog and the girlfriend. They have now the wife and the kid. So they gotta move to a place, and when you look rentals versus the price of a home, it doesn't make any sense with low interest rates. Even today, I expect interest rates are going to go up, and probably you got to do your homework. But still, in my opinion, the ratio between rents and owning favors owning over rent. And the other thing that is very important is that the pandemic increased the need with the new trend of working from home, using Zoom. And basically now the house has become a quasi commercial property. That's where we do Peloton. That's where we do Netflix. That's where we invite the people that I know that we're not gonna get, I'm not gonna get COVID. I control the environment and I work from the den and I do Zooms and I do sales meetings from my home. So it's a new trend. It's something that has really changed.
Now, Ferdinand, if you see rents going up faster than home prices, does that suggest to you that home prices will follow? Is it a leading indicator?
Usually, remember that cap rates usually follow appreciation. Right now, basically, historically, if you look for the last 10, 12, 13 years, if you look rentals, basically they have increased more than home prices. Recently, we have seen areas like the one that we built in the area of the Southwest Florida that increased the home prices at 38%. But in the past, look Sarasota. Sarasota has become one of the most expensive real estates in the whole nation. Who will say Sarasota will come like that?
Yeah.
Well, what happened is that the rentals have really gone up quite high. There is a lot of cash, a lot of assets looking for returns, and no question that cap rates lead the appreciation. And that's what is happening. Now it's catching up in the appreciation of the home. I expect somewhat to level off a little bit. You cannot continue with this huge trend. But like I mentioned, when you got those supply and demand imbalances, for me, it's very hard to say that we're going to have a crash or we're going to go down. Probably what we're going to have is we will level off and go back to normal. Increases of 4, 5, 6% instead of the craziness of 20%. That cannot continue. I agree with that.
Yeah, that makes a lot of sense to me. Now, something that I remember very well from the 06 to 08, bubble era was that now there were places where prices went up a whole lot, places like Las Vegas and Fort Myers and so on. But in general, the whole country was going up. Are we seeing the same thing? It kind of feels that way. I talked to my colleague Jarrett here, who everyone will meet in a second, my other colleague in New York. It seems that rents are rising fast in those cities. I mean, I'm in South Florida. I mean, it's bad here, but what does it look like across the map?
What is happening is that if you look at the data of unemployment, right now we have the lowest unemployment in a long time, even pre-COVID. We have a huge participation rate. That means that we got better income, we got better credit, we got better lending practices. We are more fiscal responsible on it. We're more responsible. So most of the bubble was created by fictitious, easy money, and basically with no economic sense. We have an economy right now until March. We know that the numbers have dropped and it will drop probably more. That probably was growing at around 7% clip in the GDP post-pandemic. So basically what we are looking is with low supply, high demand, high income, good credit, analysis between rents that you are paying rents, HOAs, property taxes versus owning a property and have equity on it, it really has made a huge decision on it. And one factor in Florida for us is that you got every time that a government becomes socialist, like Chile now, then it was Peru, then you got Argentina. Those monies are not going to go on. They're going to go to real estate, probably in the South. And those are other factors that not a lot of people put in perspective, that a lot of this money that is coming from Latin America is looking for real assets because they have been burned with the dollar, with exchange and the bad policies that they have. So that's an additional demand that is not there. Remember Venezuela? You are in West Palm Beach, you know that a lot, they call it Doralzuela at one time, Western Venezuela now, because basically a lot of people from Venezuela, they moved their money and they bought real property in very nice areas. So that's an additional demand.
All right. Ferdinand, I'm going to come back in a moment, but I'd like to let you speak to Jarrett here for a moment and tell us more about Private Equity Solutions and your fund, which, by the way, folks, this is for accredited investors, and we'll publish something later on. But Ferdinand, can you remind everyone the email to reach you if they're interested in investing? Sure.
My email is Ruaño, Ruano, F of Ferdinand, at privateequitysolutions.net. Don't forget the S. It's very important. If you put private equity solution, it's not going to make it. It has to be solutions.net.
All right. We'll put that in the replay report as well. Jarrett, sure. Why don't you jump on stage here and tell us more about Private Equity Solutions with Ferdinand?
Thanks, John and Ferdinand. Great to talk with you today. Perhaps you could give us an overview of your company, Private Equity Solutions, and then talk us through a bit about the Panoramic Fund, and maybe start by how you started your company.
Thank you, John. Basically, I come from the Wall Street side. I was an investment manager for 32 years. I was an investment advisor at RIA, one of the few in Puerto Rico that we start that trend of being independent, not through a major wirehouse. We built portfolios for many, many, many years. During the 2008, a lot of people say, you know what, I have been burned in the market. I have lost 40% in the stock portfolios. Can you help me? Can you find a way that I can apply these traditional portfolios and combine those with real assets, but in a format that can be easy for me to understand, that can be managed and diversified? And that's how it came Private Equity Solutions. We start buying distress. The fund was created to adjust to any type of cycle in real estate. You know that you got the growth cycle, you got the plateau cycle, you got the recession cycle, and you got the trough cycle. In each one of those cycles in real estate, there is opportunity. And we build the fund to accommodate each strategy as the market evolves. For example, in 2008 to 2010, we start buying distress. We were buying 20, 40, 35 cents in the dollar. Then we buy to rent. Then we start moving more into multifamily on rentals. And now we are mostly, with the growth that we're seeing in the markets and the need of demand that needs to be met with supply, we have become new construction. So the idea was to create the Harvard endowment type of fund. Harvard, in the analysis of the answer book, perhaps was sponsored by Bloomberg, that book in 2006, 2007. It described how these endowment companies, endowment universities like Yale, Harvard, they combine traditional assets with non-traditional assets. And that's what we start doing ourselves with the clients, to help them to navigate through tough times and get back to even at least and recoup some of the losses. Harvard, perhaps, so you know, statistically invest the money in the crisis. Almost 49% were non-correlated assets. It means that was absolute return strategies, real estate, real assets. Even they have commodities, they have land. So basically the word diversify, and only 51% was invested in the traditional way: stocks, bonds, international, emerging markets. So we took that idea and we used Private Equity Solutions as the anchor of creating and designing portfolios with investment advisors to help them to combine and be more efficient with less risk adjusted return.
Okay, great. How does the fund format differ from others we may have seen? And how does the concept of control without ownership play in here?
Basically what happened, John, that's a great question. I think the difference of the different funds that we have done, like Panoramic Fund, like the Private Equity Original Fund, they come to the premise that has to be dynamic. They have to be dynamic. They have to be proactive. They have to adjust to cycles. So basically it works like a kind of like a hedge fund that they can really adjust short or long, depending on the sectors of the market. What I do, I got that idea from there to adjust it to real estate. Now, the format is that we do everything for you. We have windows, we have distribution windows, we invest in different types of real estate portfolios. We give fixed allocations and fixed returns in some of the deals. And the fact is that we use some of this for Puerto Rican residents through the Act 60. So a lot of US, they're changing domicile to Puerto Rico, so they can have the tax deduction of the contributions of the investment. This investment can be tax deductible, believe it or not, here in Puerto Rico, where I am right now. 60% of the contribution that you put in the Panoramic Fund is 60% tax deductible against the adjusted gross income, not the net income subject to taxes. Very important in the tax return. So basically, we adjust some of these strategies. We package it in a way for US residents. We have a very dynamic way to invest. For example, we include a PLA JV, which I know the question comes because we have a structure within the fund called Preferred Lending Agreement in combination with a joint venture. What we do is that we take a piece of real estate, either multifamily or single family home. The investor put the money, is secured by a first lien, priority lien, just like a mortgage, just like a bank, is recorded. The project earns 6% while we build the property. And at the end, when the property is built, ready to market and be sold, we share the gains and convert the preferred lender into a joint venture so they can get capital appreciation plus fixed income. Perhaps, just to give you an idea, 6% is usually twice the average cap rate in the United States. If you go to Miami, if you get a cap rate of 3% or 4% or 5%, call me. I'm interested to know because I haven't found it yet, unless you are Airbnb or whatever. But that's short-term rentals. But if you look at a cap rate fixed, 6%, first position, no liability, you delegate in control, you are controlling the asset, you are not owning the asset, but you are controlling the asset like the bank, and convert into capital gains or appreciation when the project is done. I think that's a great combination because you can earn double-digit returns and have a base and a safe harbor for your investment. Like I call it a baseline. That's how we do internally with the fund. And sometimes we got international investors. They have been burned with funds. And they say, no. Let's do an agreement, not within the fund, outside the fund, like a typical property. We can do that too.
Okay, great. How do you see this fitting into an investment portfolio? And can you explain how this investment lowers risk and enhances returns?
That's an excellent question, John. Basically, so let me show you some stats. I did a research for this interview since we are in a higher interest rate, higher inflation environment, how that correlates with the markets. And the research shows, for example, that a 60-40 portfolio, the typical 60-40 balance portfolio, S&P 500, a Bloomberg Aggregate Bond Index, real estate, infrastructure, and commodities. Only commodities, infrastructure, and real estate, they participate and they deliver returns, positive returns in an inflationary environment. Real estate, and in this case, S&P, only certain parts of the S&P, especially dividend-paying stocks, they have a small positive. Bonds, negative. 60-40, negative. So commodities, infrastructure, and real estate is a high beta to inflation. And that's what you want. You want a high correlation with inflation. If we go by statistics, which has led to a perform versus traditional stocks and bonds during periods of rising inflation, number one was real estate. Number two was infrastructure. Number three was commodities. US bonds and equities were in the lower side. The other study that I want to share with you is that the rising rents give you an 80% hedge against rising interest rates and rising inflation. Which it means is that at the end, you get positive returns because you have the possibility to increase the rents and increase your cap rate. Cap rates are important because the rising rates allows you to have a net return after inflation higher than inflation. You don't do that in fixed income. The other thing is that I did a research about what about high inflation, moderate inflation? How investments in real estate perform against stocks, S&P 500? Well, this is the data. Over the full sample, the investment in real estate outperformed the S&P 500 in 56% of 12-month periods with high inflation, and over 80% of 12-month periods when inflation is high and rising. And that's exactly the scenario that we have now. It's high and looks like it's rising. So with an 80% chance of winning, and the fact that real estate allows you to increase cash flow by increasing rents, and it's a real asset, which basically in supply and demand goes very favorable and reflected in the price, future price of real assets, real estate will be a very important alternative investment in combination with the volatility that we're going to face in the market. I expect, to be honest, John, that probably we're going to have some type of quantitative tightening. And if you look at chart in quantitative tightening, when Jerome Powell announced that in 2018, take a look at it. S&P didn't perform that well. Quite tightening, quantitative tightening means that the balance sheet is going to be shrink, and the Federal Reserve is not going to be anymore the last resort to buy all the bonds that it's going to be showing on the market. So that's going to take an adjustment. And basically, that's why I believe that if you combine using the Harvard case, if you combine the fact that you have pricing power, increasing rents, people have to live somewhere, and there is a high demand. People, they told me, but what, don't you think it's a bubble, the fact that I cannot get a home and I got a pre-approval letter? I have news for you. There is a lot of cash buyers out there. They don't need the bank. That can be foreign investors, Latin American investors, people that they're selling their homes with huge equity in New York, and they're doing 1031 exchanges, tax-free in new properties with high rentals, no HOA, no property, not so much taxes in Florida or Texas. So those are the things that are moving the demand. And probably what is going to happen that it's not going to be for all the real estate. You're going to have pockets of strength, relative strength. There are two major demographic moves. High tax states moving to lower tax states. And you are looking at basically cold states that basically they're very cold to lower states. So basically, when you look at that with that trend, the demographics of movement of people, they are liquidating equity to buy more in a more tax favorable basis and better style of living.
Okay. Why will the PLA JV be a different way to invest in real estate assets utilizing both debt and equity in one unified format?
I think the idea of when we design the preferred lending agreement is that people still wants to have that control. They want to know where their money is. And the only way that you can have control is that when you are looked like a bank, you are the first position lien against that asset. So I think that the preferred lender agreement allows to give you the double the average cap rate, net 6%, control the asset, and then make a convertible. I call it convertible bond. It's not a convertible bond. It's just the structure of a convertible bond. It converts to equity of shares of that company. Well, here we convert that participation into appreciation, because when the property is finished and is sold, usually 85 to 90% has been our batting record. Pretty much we got appreciation that we can share with the investor or with the possible client. Usually we do a feasibility study to show the numbers, which type of property, we show the comparables. So we don't want to really give you an appreciation that is not realistic. And usually I'm very conservative in the numbers. Usually pretty much our estimates, usually I put it in the low range. I will be honest with you. We have been very happily surprised in the last couple of years. Feasibilities that I did for 14%, they have come in 20, 21%. But that's not the usual. I try to be very prudent when I try to advise people, because I want to be treated as I put myself in their shoes, and I want to be treated fairly with the truth so they can have a good idea of the feasibility, not trying to sell you moon in the sky.
Got it. And how does the model offer stability, income with inflation protection, and opportunity for capital growth?
I think the fact that you have the component of really getting into the investment appreciation because of what I discussed of the supply and demand in the past, and the fact that the housing market, it has a huge deficit, and the fact that you have an interest rate in the preferred lending agreement that is as compatible when you buy a mortgage, but you are the owner of that mortgage. I think that those two factors, the income plus the growth component, will allow you to control a real asset in a diversified portfolio. When you combine those two, you will have pretty much the same effect like Harvard did, Yale did, that they can really survive in these type of corrections or small bear markets in the equity markets, because those returns are going to offset a little bit what is happening with the volatility in prices in stock. So basically allows you to diminish risk and have a better beta or alpha for the portfolios. And especially when, John, you consider the fact that you can own the property. One of the clauses in the agreement is, if we go in the worst case scenario, I have to give you the deed of the property in 30 months.
Okay.
So you can do whatever you want if we don't comply. It's in the agreement. I can send pretty much a format so you can take a look at it. It has been developed in a way that is pro-customer, pro-investor, but at the same time allow to be a win and win.
Got it. Can you talk a little bit more about how the deal itself is structured and how it works in terms of compliance?
Yes. Basically, first of all, we do a feasibility for the client. We do the comparables in the area. We usually use it for new construction. Basically, we get an agreement that is tailored and done by our lawyers and property tax, real estate lawyers, that they have closing companies that they can do the recording. We present the project, we present the numbers. If the person agrees, we get the signing and the recording and the mortgage note in the process. The project gets developed as we go along. And at the end, when it's finished, the agreement says in the joint venture agreement that you can activate with a notification of 30 days before the property goes to market if you want to exercise and exchange the debt for the participation in the joint venture or equity in the gains of the property. In the feasibility is stipulated what will be the minimum base. But in most of the cases that I have in the last years, I have to share a little bit more gains because really it has appreciated a lot. So it allows you to get the recording, get the note, have the option to convert, participate in the gain at the end, and if the worst case comes, in 30 months, the property can be yours if we don't comply.
Okay. Now, is this model robust enough to face changing business cycles? And who specifically are you recommending to consider investing in this model?
I believe that based on what you have right now, I would consider definitely people that have portfolios that they are heavily tilted into financial assets, that they need diversification, and they need to understand the concept of non-correlation or negative correlation or very low correlation. So I would say those type of individuals, like accredited investors, remember that the act, the section 501A says that for an investor to invest in any type of fund, it has to earn $200,000 individually or $300,000 joint, and to have, it's either or, okay? Either or have $1 million net worth exclusive his own equity or his residence. So for these individuals that they are looking, that they have wealth, that they want to diversify, that they want to look at a different alternative in order to compensate some of the volatility, and they can have appreciation on opportunity for the next 24, 36 months, I think this makes sense, a lot of sense in a portfolio. Probably the next question you're going to ask me is, how much percentage should I allocate if I have a portfolio of stocks, bonds, whatever, following the example of Harvard. I don't recommend to go like Harvard, 49%. That's too much. I believe that's too much for most. But I think 20 to 30%, that's where the money is. I think it's something that can be, for example, a person that has a $1 million portfolio, probably allocate $200,000, $300,000 in a type of preferred lending agreement, joint venture in a specific property in an area that is kind of not that risky, even if we go into a inflationary environment. And who knows, maybe based on the last numbers that I saw on Goldman Sachs, they say 35% possibility of recession, small one, but possibility with inverted yield curve right there. I imagine that Powell made a decision about interest rate today. I hope it's 50 basis points. But those are things that the investor has to consider. And based on my experience, it really makes a lot of sense when you diversify and you look the assets in a total approach of traditional and non-traditional investments. And that's how we advise the people. And that's how I believe that they can really go for the long term without getting this aggravation of looking at the market going 900 points up, 900 points down.
Indeed. Well, that's a good segue to my next question, actually. Where do you see this form of investing in 5 years, and what impact will it have on the status quo strategies currently in use in the real estate world?
That's a great question. 5 years is a long time. 5 years is an economic cycle, by the way. But I will answer it. I believe that if you have a dynamic strategy in real assets, I will be honest with you. I made my best money for the fund in the crisis. I bought property in Key Biscayne for 20 cents in the dollar. I don't have to tell you how much that price has appreciated. I bought in Orlando, believe it or not, 21 acres of land for $165,000. Okay, I don't need to tell you what that means, especially in Goldenrod 408. So those opportunities, when you have cash and you have investments that you were diversifying enough to lower your risk and keep your powder dry, the market will give you the opportunities. You just need to know the strategy and the dynamic allocation that you need to focus yourself. And that's basically how I would recommend it to the people. I think that in the next 5 years, there's going to exist huge opportunities. I think the market cannot go forever. We are really looking for the next distressed market because we're going to be in much better shape with more purchasing power and to buy a lot of assets at very ridiculous prices, probably. I will be honest with you, based on my numbers, I don't see that coming. Probably we're going to have a little bit of a plateau until we don't get the deficit of this supply and demand. And interest rate goes for probably 10%, which 10% is serious. I mean, you're talking about stagflation. You're talking 70s, all deja vu all over again. I don't see that. We got so many things in the economy. You got technology. The human being is so productive right now. Guess what happened? What China wants from the United States? The technology. That's the crown, the jewel. We dominate technology. They don't. So when you got those deflationary forces, and you got productivity, and you got basically United States has become the most attractive country. Now Europe, look Europe. I mean, the war, that's a black swan event. They're going to be affected with it. United States is one of the few countries that have the control. They can become the next exporter in oil if they want to. They can switch, like that in 1 year. What kind of, Europe cannot do that. And we have the technology. So when you combine these things, the safest place to invest is the United States of America. No question in my mind about it. And real estate assets, real assets, is something that should become part of any portfolio. Doesn't matter if you are a great hedge fund manager or whatever. I think you need a piece of real estate. And we allow people, just answering John's question, I do a 360. Probably these two formats. Either I want control, Ferdinand, like some of the guys say, I like you, but I like control. Well, we can do it for you. Listen, I trust you, like our 120 clients that we got in our small fund in Puerto Rico. I know your track record. You're good. I know how I have seen you in down markets, up markets, middle markets. Manage it for us, report to us. So basically you have the easy way, delegation way, diversify way, and you can have the control way with project specific.
Okay, great. I'm going to pass the baton back to my colleague, John. Take it away, John.
All right. Thanks a lot, Jarrett. Ferdinand, I got a few questions for you here. One is, we talked about, and I really like how you lay this out, the supply-demand imbalance. Is that uniformly true across the country, or is the imbalance more severe in some places? Because I think a lot of people will remember that during COVID, you had people leaving the cities and going to nicer climates like Florida or, places like Asheville, North Carolina, places that were more comfortable. Do you think there's still an imbalance in those places? Because we sure know a lot of people headed out there, and I think a lot of them have stayed.
I think that you hit it right on the nail. I think that there is three major situations demographically in the whole United States. One, people are moving from colder weather to hotter weather because they want to enjoy a style of life, especially baby boomers, okay? Number two, you are moving money from high income tax states to lower income tax states. That's another major move. And third, it's important, they're moving from high density populations to lower density populations. And that style of living where I can now work from home, I don't have to really dress every day, spend the money for lunch every day, spend the gas that is so expensive for every day, that is contributing to high liquidity, high and very good. In my essay, I explained the debt to income ratio, it hasn't been better for the last 10 years that we're having now because we didn't spend the money.
Yeah.
So basically what happened with COVID is that money went to pay off debt and basically became more buyers and more demand of what really the supply was. So I believe that these trends, as we go along, they're gonna still facing the whole nation. Now, going to your question that probably you're gonna have areas where it's gonna feel more the effect. Absolutely. Arizona is benefiting from what? The higher taxes in California. And basically they have a great business environment. Look, Texas, the same. A lot of industry, a lot of people moving there. Florida, of course, you got the three Americas. North America, the Canadians, which basically are buying a ton of real estate in Orlando and probably in Cape Coral, believe it or not, because it's cheaper than Miami, Fort Lauderdale, and West Palm Beach, and they can afford it. You got Germans buying in Cape Coral because basically the German taxes are huge. It's cold and it's becoming expensive, and now it's going to become more expensive with gas and oil, and they have the style of life. So you got Central America, South America, political events that everybody knows what's happening. Now Colombia is going through a tough election coming soon, and looks like the guy from the left is winning, like happened in Peru and Chile. So those monies, where they're going to go? They're not going to go to Europe. They're going to come to probably Florida, North Carolina, Texas. So that's the trend that I'm seeing right now.
That's really interesting. I want to just rewind a minute if we can and go back to what we all witnessed, a decade ago. Can you just tell me a little bit more about what happened with the banks? So, all the banks got the TARP money, right? And all of a sudden the government is watching them very carefully. They can't let someone buy 6 houses, like, these crazy stories we heard about in Las Vegas and Fort Myers. But I remember also there were attempts by REITs, and others to try to come in and fill the gap, but it didn't really work, did it? There still was not, the credit was still tough. So there wasn't as much building. I'm just trying to understand why the supply didn't appear.
Yes, that's a great question. I will tell you a little bit of history. Probably it's going to be a long answer, so hang in there with me. What happened was that George W. Bush, one of his main campaigns was that every American should have a home. And the Federal Reserve under Bernanke bought the bullet and said, don't worry, we'll make it money easy and we will lower interest rates. And then you got Standard & Poor's and the other ones just getting this subprime stuff that never should exist.
Yeah.
The banks become really, that in Wall Street, you say you got greed and you got fear. Greed is not good. I'm sorry for Gordon Gekko. Greed is not good. And basically, fear paralyzes you. Okay? So those two extremes are not good. And we did that in a switch in 3, 4, 5 years. But part of the deal was that banks were making a killing, securitizing that debt. So they were selling that like hotcakes and making fees and investment banking fees, and it was a house of cards.
Right.
Because really they were selling toxic stuff. But they have the stamp that is an investment grade investment, and the pension plans in Switzerland and Sweden and all that stuff, they bought all that stuff and exploded. But to be honest, the credit was so, listen, Alan, if you have blood pressure and you walk, just put the income there. I just need you to put $200,000 here so I can put it to the committee and you can get approved for the loan, okay? Don't worry about it. No, we're not gonna verify, just put there. That's what happened. And then they start leveraging themselves, buying the adjustable rate mortgages. Interest rates started going up and they got crucified. Nothing of that is happening right now.
Right. And in the subsequent years, and this is the thing that I'm trying to understand, the banks just, they started lending much less, and they were much more careful, right? And a consequence of that is that there are fewer homes being built. Is that right? I'm connecting the dots.
What happened now, that was the story. That was the storm. Now I will tell you the end result. One good thing about Dodd-Frank, even I know if you talk to a mortgage guy, says the worst thing ever happened. I disagree. What happened with Dodd-Frank, remember that in compliance, you go very loose and then you go too tight.
Yeah.
Dodd-Frank turned the switch from what I told you, the mania, it turned the switch in compliance. And what happened was that a lot of the credits were shattered because people, they have negative equity, negative amortization in their loans. And they say, why in the heck I'm gonna keep the house? Get rid of it, we will deal with the credit later. And that's what happened. They start dumping all this stuff. That's not the case right now. You got huge equity. And perhaps right now there is a phenomenon that not a lot of people, just remind me to go there about this thing is getting worse on the imbalances of supply and demand. I will tell you why.
Yeah.
In a short minute. Let me complete it. From there, Dodd-Frank comes and say, you got all these type of restrictions, and I'm gonna charge you if you got a default loan. You cannot lend that money. You gotta provide double reserves. And then if you build a house, listen, you made $300,000, but your credit is $580. I'm sorry, I cannot give you the loan. Increasing down payments, all of these things definitely is something that has affected quite a bit the situation with the financing of ownership. So the builders notice that it's difficult. New York and California impose huge amounts of hurdles in building. And New York and California, they are major parameters. Talking about nationwide, they are the leaders on that real estate, okay? So they were putting a lot of impositions in building, a lot of restrictions. You got people shattering credit. So you got the perfect combination of shrinking of supply. Then, like everything in life, start healing process, start people getting back. We go through the Great Recession, people are recovering. Banks start to get more comfortable with the economy, start losing money, but it's still, the builders were more emphatic. They were more concentrated in multifamily. They didn't want to have to build single family because still, you know that this 10 years of shattered your credit. So you won't be able to sell it unless you get all kinds of incentives. So the rate of return on that way, multifamily was a much better deal. And that's why you're seeing a lot of permits in multifamily, not that much in single family homes.
You know, it's interesting, Ferdinand, because I can tell you from personal experience, I'm in an Avalon Bay condo here, and my rent has gone up a lot. And some of my neighbors have seen it go up even more than mine. I think 50% in some cases, just most recently after a year. So there's still a lot of appreciation in there's a lot of rents are rising a lot in multifamily too, right? But what you're saying is that the supply of multifamily is not as scarce. It's a single family.
Yeah, it's the single family where right now there is a need. And basically what is going to happen now, I will tell you what's happening right now in the effect and why Blackstone is buying $1 billion per month in new multifamily and other types of housing with rents and campus rooms and housing and all that. The reason is this. People that they were saying, okay, now I can probably move to Texas and I have my house in New York. I can probably lower taxes there. Let me sell the equity in New York. Let me do a 1031 exchange and let me buy a couple of pieces of property. But guess what? Now the rates are higher and probably their mortgage is in a 3%. Why I'm going to list it to get into a 5, 5.25, 4.75 new mortgage, even if it's 50% financing. Interest rates hiking has discouraged the listings and the supply of more living and housing in the market. At the same time, the millennial that now the apartment is too small because now they have a kid and now their girlfriend is his wife. Now they're moving and say, the train is leaving the station. Let me get on before they get worse. So those things are happening right now. And that's why you see in Zillow, the analysis was to increase 14% at the beginning of the year. It was at 20%, 19.8 nationwide.
Wow.
And then Blackstone, you can see is a buying spree, buying multifamily properties. So that tells you that there's something is going on.
It sure is. All right, Ferdinand, I want to just touch on one last topic here. Let's drill into the Panoramic Fund. Where do you see the opportunity geographically? Are you talking South Florida? Are there other parts of the country that are potentially interesting? And are you looking at mainly single-family developments? What kind of assets are we looking at?
That's a great question. Basically, right now, just having a kind of like I don't know, you like hockey. I have become I am a baseball player. I am a Yankee fan. Sorry, guys, for the Mets. I like the Mets too. My brother is a Mets fan. But I am a Yankee fan and a Marlins fan. But I am in love with the Panthers. I hope that they do good. I think that they have a great team. You have to follow the puck. I think that you have to understand that right now, there is basically a huge demand in Southwest Florida. That's where we are really, really focusing since 2017. Especially what it's called Lee County, is south of Sarasota, north of Naples.
Oh, okay.
That area, based on the last statistics, Forbes magazine rate Cape Coral the top real estate piece of property that you can have, and Southwest the fastest growing area in Florida. That was last year and this year. I have been there since I have seen that it's a very attractive place. They have water, they have beaches. They don't have to pay that much HOA. I can see the feasibility. I can show you the feasibilities and the cap rates in that area. It has become a very popular place for build to rent. Okay. The absorption rate is 19 days. 19 days. The absorption rate for the United States is around 6 months is the level, 4 months is low. Imagine 19 days. That's
Wow.
basically the average absorption period, listing to contract. So there is a huge need because people are moving into that area and they want single family homes. They prefer single family homes in that area. This is not a major city. Remember the trends, high density to lower density. So that area of the Lee County, that's where we're really focusing in single family homes. Now, Orlando is a different story. Orlando is one of the best rental markets that you can have. Disney, of course, now we got the governor dealing with Disney and all that, but Disney is moving a lot of people from California to Florida. And they need residential homes or multifamily. We are bullish in multifamily in areas like Orlando. We are bullish in single family homes for the Southwest Florida. And that's where I see the opportunities right there.
Great. Just one last question for you, Ferdinand. You know, as some of us might remember, there were some hot spots during the bubble, I think pretty close to where you're talking about, Fort Myers, Las Vegas. And my impression at the time in 2009 was there's so much inventory, it'll never get eaten up. But has it, even in those places?
Yes. Just to let you know, the 4 to 5 best places of real estate nationwide are Vegas, number 1. It came back with a vengeance. Number 2, Raleigh, North Carolina. Number 3, Cape Coral. Number 4, Orlando. Number 5, Austin, Texas.
Yeah.
Those are the hottest. So you can take a look at it. Oh, by the way, Scottsdale, Arizona is a hot place too. Okay, it's a very hot place too. So you're talking from west, northeast, southeast, central. It's across the board, but there's some spots. Remember, Austin has developed through the cooperation with University of Texas, the Longhorns. Basically, they're building a technology platform. Michael Dell is there. I think Tesla is building a factory there. So it's a lot of attraction for building businesses there. It's a great community. It's becoming a very nice, they're becoming a power think tank in technology.
All right. Well, Ferdinand, I think we're going to leave it there. I encourage anyone who wants to learn more about this fund and Private Equity Solutions. Ferdinand's a very approachable guy, so you can reach out to him directly. We'll publish an email address on the replay, which will be up in a couple of hours. But Ferdinand Ruaño Arroyo, thank you so much for joining us today. This has been terrific, very educational, brought me back to the crisis. I learned a lot this afternoon, so thanks for joining us.
Alan and John, thank you so much for the opportunity. I really enjoy. I really appreciate your effort in really get it the Ñ, the Ruaño Arroyo on it. Not a lot of people does it.
All right. Yeah. Have a good afternoon. Thanks again, Ferdinand.
Take care. My pleasure.